Welcome to TLD Talks, where we share insights about key legal and business matters that are impacting SMEs today. Bringing together experts from a range of backgrounds, we will be tackling the issues that matter to you. I'm Ed Simpson, founder of The Legal Director, and on today's podcast episode, I'm joined by one of our very experienced client legal directors, Jeremy Aron, and Head of Tax at Sanders Chartered Accountants, Michael Graham. And we're going to be talking about exit planning and in particular how to maximise the tax advantages that are on offer to an entrepreneur who's thinking about exiting their business. So hello Jeremy and Michael, thank you for joining me today. Could I ask each of you to briefly introduce yourselves please and your respective practices? And Jeremy, if I could start with you please.
Thanks very much, Ed. Yes, I've been with the Legal Director for 4 years, working with a number of small, medium-sized businesses on a number of corporate transactions. Prior to that, I was with a FTSE 100 business, which grew from a FTSE 350 business. So I spent a lot of time working on a number of different corporate transactions. So I would say, yes, I've had plenty of exposure to exits and all kinds of corporate transactions over the years.
Thanks, Jeremy. Michael, could you introduce yourself, please?
Hi, I'm Michael Graham, and I'm Head of Tax at Sanders. We're a boutique accountancy firm based in Baker Street, and we specialise in advising high net worth individuals and owner-managed businesses. I head up the tax team here. We provide bespoke advice on a wide variety of topics, including business exits, which we'll be discussing today.
Fantastic. Thanks both. So let's get straight into it. We are, by coincidence, recording this episode a few days after the Labour government's first budget, which included some headline changes to capital gains tax, which will directly impact anyone thinking of selling their business. And Michael, I think this is probably one for you to start off on. Could you please summarise the changes that were made in the budget that are relevant to what we're talking about today?
So yeah, there's quite a lot in the budget and a lot in relation to exits. Most directly applicable, you've already alluded to, and that is the changes to the capital gains tax regime. Effective from budget day, there was changes to the headline rates. So they've increased from 10 and 20% to 18 and 24% respectively, but there's been no change to the residential property rates. In addition to changing those rates, there was also changes to some of the reliefs available on an exit, including business asset disposal relief and also the lesser used investors relief. Business asset disposal relief is the one we usually think of. That's previously known as entrepreneurs relief. They've retained that limit at £1 million of relief that's available to exiting shareholders. But over the next couple of tax years, we'll see that rate rising from the current 10% to 18% by April 26. So still some relief there, but less than has been previously. In addition to that, not usually what we think of when we talk about exits, but there were some changes to agricultural property relief and business property relief, which would affect intergenerational exits. So that's passing the business down to the next generation. Because of the changes to the reliefs available there, there'll probably be some things people will be wanting to think about how they structure those legacy transactions going forwards.
Thanks, Michael. You mentioned business asset disposal relief, formerly known as entrepreneurs relief there, and that's one that I think most entrepreneurs have heard of and understand that it allows them to have part of their gains taxed at a lower rate. Could you say a little bit more about that relief and how it works, and in particular, what a business needs to do to qualify or an entrepreneur needs to do to qualify?
Yeah, so business asset disposal relief is a very well-known relief that is available to directors and employees, business owners who are selling the shares in their UK trading company. As I mentioned earlier on, the rates are changing over the next couple of years, but the crux of the relief is that the first £1 million of gains made on a qualifying disposal of shares benefits from a reduced rate of CGT. It's a very valuable relief for shareholders at the moment, and particularly valuable when you factor in that a lot of businesses are structured as husband and wife being shareholders, so potentially a family could benefit from a lower rate of CGT on an exit on gains up to £2 million. After that, 1 million or £2 million in the case of married couples, the rates revert to the normal rates of CGT. It is a relief, so as with all reliefs, there's certain conditions that have to be met. For business asset disposal relief, these conditions have to be met for a period of at least 2 years, ending with the date of sale. The first condition is that the shares that are being sold must be shares in a trading business or the parent company of a trading group. Secondly, you must be an officer or an employee of the company. And finally, the company must be your personal company. There are intricacies within that definition, but the crux of it is you have to hold at least 5% of the ordinary share capital, entitling you to 5% of the voting rights and entitlement to 5% of the assets of the company on a sale or a winding up. That last condition, the personal company condition, is relaxed for EMI holders, which is something we'll come on to shortly. And they can benefit from BADR even if they aren't a 5% shareholder in the company.
Okay, so I can see why you describe that as a very valuable relief potentially for a wide range of people that might be involved in the shareholder group. And obviously, what we're trying to do, or what advisors are trying to do, is to make sure that gains are taxed under the CGT regime rather than income tax. But I'm guessing that if you've got this sort of crossover between employees being shareholders, there might be some traps there for the unwary. And I'm thinking, you mentioned EMI options earlier, but what are the sort of traps that you might sort of unwittingly find yourself in, whether it's to do with sort of options or if employees have actually become shareholders? What are the sort of things that can go wrong there?
Yeah, so it's a very important thing and something we see a lot with clients. You're bringing employees in as shareholders, you're trying to incentivize them to grow your business and move to an exit, and therefore you want to make sure that on the exit they get the exit that they think they're going to end up with. A top line point I would say is, where possible, use the HMRC approved share schemes, things like EMIs and CSOPs. Very, very common with the clients we work with, these owner managed businesses. The reason for that being is that you can enter into discussions with the revenue around important things like valuation, which will ultimately impact the tax treatment of these options when employees come to exercise them. They come with some very valuable tax relief. As we've said, they allow employees to access business asset disposal relief on an exit, and they can be quite flexible as well. It is a broad topic, talking about what are the pitfalls. My main piece of advice here to business owners would be to take advice when they're coming to give equity to their employees. Engage with your advisors. That's what they're here for. They understand the rules and the regulations and the steps that need to be taken when granting equity and options to employees. I've seen situations where clients haven't necessarily taken advice and things haven't been done in the correct way. Perhaps it's some of the admin wasn't done correctly. And when they've come to the end, they've come to us with an exit and they haven't quite got the outcome they were expecting for their employees.
Obviously, some traps for the unwary. Very good advice to any business owner thinking of giving shares or options to take advice and make sure that it's done properly. Because obviously what you don't want when you start on your journey to an exit is if you find these things out and they either materially impact the value or potentially the value that one or more of the owners is going to take out. And Jeremy, it's something that we're often asked to help with, is this sort of wider topic of getting businesses ready for sale and due diligence and what's known as vendor due diligence. Is that something that you could sort of explain what that concept and what that really involves?
Absolutely. And I mean, I think it is extremely important for a seller contemplating an exit to know where the skeletons are, to be able to move forward swiftly in an exit transaction without the distraction or concerns that may be generated by discoveries made by a buyer. So there's often a question, because it has an impact on cost, as to whether or not there's benefits in doing vendor due diligence. Vendor due diligence is, of course, a process commissioned by the seller to look at the state of the business and undertake a number of sort of inquiries by external experts often, and to prepare a report, which is then made available to the buyer. The advantage of doing something like that, as I've said, is very much to find out things that maybe you as a seller didn't want to know, but which it's very useful to know because you're then in control of the process far more than you would otherwise be.
And presumably with some of those sorts of issues, there then might be an opportunity to fix them or correct them, as you say, at a time when you're
Correct.
in control of the process rather than trying to do it a week before
Correct.
completion of your deal.
Absolutely, because you can lose control very quickly of the process if something comes from left field. And that can put you in as a seller, in a very difficult position. You may ultimately decide you don't actually then want to proceed at all, which of course is potentially very unfortunate. You may well have incurred very substantial costs by that time. So find out as soon as you possibly can if there are any problems in the business, and think and plan with the likes of someone like Michael advising you on tax and related issues, so that those surprises are, to the best possible way, mitigated.
Michael, I'm sure you've dealt with some horror stories, and probably Jeremy as well, over the years. I mean, when you mentioned potentially options not being granted correctly, what would be the outcome there? So you have an employee who thinks, oh, this is great, I've got options over 5% of the company under an EMI scheme, the company's going to market, I'm going to have a nice little windfall, and BADR is going to be available, that very generous relief. And you do your vendor due diligence and you find there's been a problem with how those options have been granted or not granted. What's the implication there for the founders of the business, the sellers that's taking the main value?
Yeah, as you say, we've seen a number of different situations where this arises. And one that immediately comes to mind is precisely that. It's a transaction where the directors came to us and said, we're looking to sell the company. Can you advise us on this? And we said, yes, you can. We started going through our usual checks, and there was an EMI scheme. But as part of our due diligence, we discovered that the administration around the EMI scheme hadn't been carried out correctly. And unfortunately, these EMI options that benefited from all these fabulous tax reliefs had actually ceased to qualify as EMIs and became unapproved options. What does that mean? It essentially changes that gain from capital gains into an income gain. And the employee was then subject to income tax and NICs on the exit. And in that situation, the directors stepped in and they underwrote the difference in the tax treatment for that employee because they were unhappy that the employee wasn't getting the exit that they were expecting. So it came at a substantial cost for those exiting founders.
Yeah, so potentially something like that can impact the overall value of the deal, but it could, as in that case, it impacts the founder's pocket as well, that they stepped in and made whole the employees. Well done them. But if they'd taken the right advice at the right time, then could have been avoided. So thinking about then how the deal is structured, are there some opportunities there for tax efficiencies, tax planning? And I'm thinking in particular about, at a very basic level, what it is you're actually selling. So is your business structured as a limited company, or is it a partnership or a sole trader business? Are you selling a trading company? Are you selling a parent company with subsidiaries? Are you just selling assets rather than shares? So can you talk about some of the differences there and how that might play out in terms of different tax outcomes?
Yeah, of course. Typically, we work with limited companies, so that's the scenario we most commonly see when it comes to an exit. As you said, there are sole trader and partnership exits that can take place, but a lot of our clients like the limited company structure because of the limited liability that it affords them. So if I'm focusing on companies to begin with, there's a variety of different things that can happen. There can be a share sale by the shareholders. That's a personal tax event that will, in most cases, be subject to capital gains tax. And it can be quite a neat and easy way to exit the business because the founders are selling their direct holding and receiving cash directly for it. It doesn't become trapped within a company where they then have to extract it. That's not always possible for a variety of different reasons. You could have a group structure and the purchaser may only want part of the group. They might only want to buy some of the companies within the group and not the whole group. In that situation, you'd see the parent company selling its holding in a subsidiary. And often in those situations, provided the conditions are available, you'll see substantial shareholding exemption apply, which will exempt the corporate gain on that sale. But if it doesn't, any capital gain arising on the sale of those shares will be subject to corporation tax within the parent company. And then the shareholders would need to extract those funds, which would come at an additional layer of personal tax, most likely a dividend if they've been unable to sell the whole group. And again, the purchaser might not even want an entire company from the group. They might just want the trade and the assets, and that can be for a variety of different reasons. The company could have grown organically and it could hold some things that the purchaser doesn't want, or they might just not want to buy the existing company structure because that comes with all the history and the legacy of that company. And they might say there's some things in there they don't want and they just want to buy the trade and the assets.
Presumably in that scenario, so the business selling its assets, it receives cash. It would have to work out what its gain was on those assets, and that would be subject then to corporation tax.
Exactly.
The gain there, okay. But then again, you've got the second level of tax when the shareholders take the cash out of the business.
Exactly.
Okay. So potentially a lot more efficient from a tax perspective by selling the company rather than assets.
Exactly, and a fundamental principle there is understanding your structure and what you have to sell. We had a situation recently with a client. They came in close to completion of their exit, and it was a two-company structure, a parent and the trading subsidiary. And they said, we're selling the trading subsidiary. And we said to them, does the parent company own any other assets other than the subsidiary? And if not, would the purchaser be interested in buying that parent company from you? And they went away and had a conversation with the purchaser, and the purchaser said, absolutely. And it made it a much more straightforward transaction for that individual because they just had a share sale then and the funds didn't become trapped within that parent company. So that was a very simple thing they could do to make a much more efficient transaction for themselves.
And then thinking about sort of other things that a founder might be advised to look at pre-deal, so as part of the getting ready. You mentioned there certain deal structures, you can end up with a lot of cash effectively trapped in a company, and the shareholders have then got the headache of how do we get that out in an efficient manner. If your business has been very successful and actually is sitting on a lot of cash before you go into the deal, are there things that can be done to either sort of extract that cash beforehand or shelter it in some way, effectively excess cash in the business so it's not needed for ongoing working capital? Are there things that can be done there to effectively enhance the value of the deal for the shareholders in a tax efficient way?
Yeah, always when you're approaching an exit, you want to be looking at your balance sheet, seeing is there anything on there that needs cleared up. If there's excess cash, there may be directors' loan accounts that need to be repaid, and that cash could be used to repay those directors' loans in a very tax efficient way. If there's not, then it's a consideration of should a dividend be voted pre-sale to make sure that the directors are extracting the value and the profits that they have generated whilst they're the owners. And then, of course, there's other situations where that cash is needed as the working capital. So it's not really free cash or excess cash. And in those situations, you'd be expecting that to be reflected within the consideration for the deal.
And then what about sort of thinking about timing of transactions? Often I've seen transactions are driven by the buyer's financial year end. But are there any things that a seller might be looking at in terms of timing when a deal actually closes that could give them a benefit?
Yes, of course. There's a number of different things. Timing can be a critical factor when it comes to the tax treatment of a disposal. There's a number of different clocks that we think about, and they're relevant for things such as business asset disposal relief, substantial shareholding relief, and investors relief, which we've touched on previously. timing can make all the difference with those reliefs, because for the case of business asset disposal relief, you have to have held the shares for 2 years. If you've held them for 1 year and 11 months, it doesn't qualify. In those situations, we've encouraged clients to negotiate with the purchaser. Can you delay it a month? Because it then allows them to qualify for that relief. And that's something we've seen clients successfully be able to negotiate with the purchaser. Sometimes the purchaser won't budge. And as you say, they can be the one controlling the deal and pushing it forward because they've got the purse strings. But where you can, it's important to have an open discussion with them about it. And even not looking at reliefs, just looking at when did you make your sale. Selling on the 5th of April can be very different from selling on the 6th of April. The reason being a sale on the 6th of April would fall in the next tax year, which would give you an additional 12 months for when the payment date for the tax comes due. So again, it can buy the seller some time. And that's particularly helpful where the consideration is in stage payments, because they might not have received all of the funds they'd need in the first payment to fund the tax. And it just buys them a bit of time to get their ducks in a row.
Great. And then thinking about the deal process itself, and Jeremy, this is an area where you've done lots of work over the years. Are there ways that once you're into the deal process, you can protect yourself and your tax position through the deal documents, I guess?
Absolutely, Ed. Typically, you'll want to make sure as a seller that you are giving as few a set of warranties as is practically possible. Often in this sort of space, you people will have heard horror stories of reams or tens of pages of warranties that are often demanded by purchasers when buying businesses. It's important to manage that process the best of your ability to ensure that you're not really just presenting the purchaser with an open check going forward. So negotiate a reasonable set of warranties, absolutely critical piece of advice. And then in terms of sort of tax liabilities, very often in the context of a share sale, there will be an issue of whether or not to provide a tax deed, which is basically a tax indemnity in favor of the purchaser. If there is to be a tax deed provided, and I'm sure Michael will agree with this, make sure it is as tightly drafted as possible and as limited in scope as possible to make sure that there are no sort of contingent liabilities that will sort of pursue you into the future and dampen those retirement plans that you have.
Fantastic. Thank you. So it's been a bit of a whistle-stop tour through some of the considerations that founders should have in mind when they're planning for an exit. We always like to end our podcasts with top tips. So could I ask you please to give your 3 top tips to any founder that might be thinking about exiting their business in the near future from a tax planning perspective?
So the top tips, I think structure, understanding your structure, and make sure that as the business is growing and developing, you're thinking about your structure and where things sit. Being mindful of reliefs and the conditions for those reliefs and making sure that they are met. And slightly unglamorous one, but get the admin right as you go along. And where possible, enter into discussions with the revenue, because it can be very valuable. Things like clearances and things. Approaching the revenue always sounds a little bit scary, but if you can get something from them that gives you clarity and helps you understand the tax treatment of your transaction, for good or for bad, that's always worthwhile doing.
Thanks, Michael. That's really good tips there. Jeremy, anything to add?
Just a few things from some lessons painfully learned. I think when you're in discussions with a buyer, make sure that you very clearly define exactly what's being sold, and particularly around the areas Michael's touched already on cash, but also on the definition, getting a very clear understanding of debt. If there's debt in the business, what is actually included and what is excluded. A second tip I have is whenever you possibly can, make sure there's competitive tension. I've seen too often situations where sellers are squeezed by one purchaser and end up regretting the fact that they didn't have more competitive tension in the process, whether that's another potential purchaser or just a means of keeping some focus like exclusivity or limiting the period that can actually be used as a negotiation period. And finally, I would just say, make sure you have good advisors. I mean, clearly bring Michael in, clearly bring myself or one of my colleagues from Legal Director, but it's so important to have people who really are well trained and know what they're talking about.
Fantastic. Thanks, Jeremy. Thank you, Michael, as well. That brings us to the end of today's podcast. Thank you for listening. If you enjoyed this episode, you can subscribe to our monthly TLD Talks podcast series, covering a wide range of legal and management topics. You can also find TLD Talks on Apple, Spotify, and Google. The details are also on our website, thelegaldirector.co.uk. If you'd like to know more about planning for an exit or the wider work of the legal director and how a part-time legal director can save you time and money, do please give us a call on 020 3056 8538 or visit our website.